Well, thanks for coming out, guys. I really appreciate it. Let slideshow get started here. So welcome. Tonight we're going to talk about market volatility, inflation, and some estate planning. So I think you all know me. I'm Dustin Hunter. This wonderful gentleman over here, this is Joseph Vanderhulst. We work with him. He's an attorney, and he's going to be talking about the estate planning portion a little later. So in particular, wills and trusts, how those things go together, and the roles they might fill in your estate plan. So some pretty good information there coming up shortly. Here's the wonderful disclaimer with the text. It's too small to read, but I can send this to you if you really want to read it. 2022, off to an eventful start. Volatility, inflation, interest rate hikes, war, COVID still. And, you know, to keep it lighthearted, it's tough to make predictor. Probably all heard that from Yogi Berra. And if you've been doing this very long, you'll notice the smartest people in the world talking about these different topics, they actually disagree on a lot of these, and they're wrong a lot of the time. So our goal isn't trying to outthink the smartest people in the world. Our goal is to try and add context and perspective so that you can make better, more informed decisions. So I think it might help to give a quick recap. 2020, 2021, so far in 2022, what are some of the things we've gone through to get to this point? And roller coaster might be a pretty tame term to use, but we started in 2020, this thing called COVID that people really hadn't heard of before, started dominating the headlines and affecting all of our lives. So COVID caused the fastest bear market ever. So the Fed cut interest rates to zero and ramped up quantitative easing, which means where they buy bonds all the time to support the economy. So then the government gave people, you and me, and businesses free money. So we got the fastest bull market ever. So technology in particular ripped higher that year and into 2021. So then e-commerce boomed as people were getting sick and stuck at home. But we're not done yet. So the supply chain suffocated with 3 times the demand and 1/3 of the capacity. So then demand went up while supply went down. So surprise, surprise, prices rose and have been rising from Economics 101. So the Fed, you probably know, has a dual mandate focusing on jobs and employment and inflation. With employment being okay in more recent times, here comes inflation reconciliation. So toward the end of last year, and especially some tough talk so far in 2022, interest rate hikes are on the table. We've already had one. So stocks and technology in particular dipped. That brings us somewhat up to date for today. So looking back at last year, isn't this wonderful, this up and to the right thing? It's got some bumps, but boy, up and to the right's what you want to have. The S&P 500 in 2021, 70 record closes. And you might not think of it this way, but these bumps and then going in an upward fashion, that's positive volatility. And it's a normal part of the investment experience, but there's a flip side to that. Surprise, surprise, here we are in 2022, and we have this thing called negative volatility, and it's also a normal part of the investment experience. So January was the worst January since 2009, down a little over 5%. We entered correction territory, which we'll talk about in a minute, in February, down a little over 11%. However, we got into March and we started rallying about 10%. So we were down as much as 12 something, and we ended the quarter just a tick under 5% away from 5% down. And that was the worst quarter since Q1 of 2020 when COVID hit. So maybe it helps to cover a few of these terms. You hear them talked about all the time. Since 1949, over a 70-plus year period, on average, the S&P 500 has experienced a pullback of 5%, about 3 times a year, a correction once every year, and that's about a 10% move in the market, and then a bear market, which is 20% or more, about every 6 years, just to give you a feel for when those should be expected. So I think it's helpful maybe to give you some reminders about the stock market. One, it moves fast. New all-time highs, believe it or not, with all the volatility we've had, we actually had new all-time highs on the first trading day of 2022. But the S&P 500 fell nearly 13% through early March. And from that time, in 3 short weeks, just before the end of the month, it bounced back nearly 11%. So it's moving, it can change very rapidly. Another important thing is price can change the narrative. Remember the headlines a few weeks ago? They went something like this: stock market sells off on fears the war in Ukraine will make inflation even worse than it already is. Okay, but a little more recently, now the headlines look something like this: stock market rallies as investors realize they act as an inflation hedge. Now, what actually changed? Well, the price changed and we had some stock market improvement. So prices falling, well, it must, the prices are falling. It must be obvious to the casual observer that inflation is a huge risk and the war will drag on forever. Oh, wait a minute, prices rising? Oh, it's obvious stocks provide an inflation buffer because corporate earnings are still strong and those can grow. And gosh, maybe the war could end sooner. So be aware, price changes the narrative. And the market doesn't always care about what's in the headlines. For better or worse, the market tries to be forward-looking. Sometimes you'll hear that the market has predicted 10 out of the last 2 recessions, things like that. So it can be wrong, but it doesn't care that much about the headlines. Did the stock market front run the end of the war, rising 10% in the last 3 or 4 years? Well, maybe. We'll talk about that a little more too. Over the past year, the U.S. stock market is up more than 13%, although it doesn't feel like that right now. Just a few fun facts related to that. More than half of all stocks in the U.S. are down 20% or worse from their 52-week highs. So there's a lot of pockets of businesses that are down. More than 1/4 of all stocks are down 40% or worse from 52-week highs. So there are certain areas that have been hit much harder than others. And we'll talk about that too. So another thing, why did God create economists to make weather forecasters look good, right? No one, and I mean no one, can predict what's going to happen in the short term. I know if I could, I'd say to you guys in meetings, I'd be in Vegas betting it all on red or black if I could predict the future, and I'd own an island somewhere right now. I don't see people doing that, so I don't think very many people can. The stock market is driven by all kinds of crazy things, profits, economic data, expectations, greed, fear, geopolitical stuff, human behavior, and it's this amalgamation that's hard to predict. Now, a blogger and guy on Twitter that I like to follow said, a radio interviewer once asked me what my year-end target was. I said December 31st, and he hasn't been invited back. So I always like that one. You guys are probably aware of this. Human nature says we gravitate to predictions and pessimism. Even though the weatherman's wrong all the time, you still wake up the next day to see what Chuck Lofton's going to say. Chuck's a wonderful guy, but he's not going to be right 100% of the time. So if you're looking for things to add to your to-read list this year, this is a great one. The Psychology of Money, Morgan Housel. So he talks about this. Pessimism about money takes a different level of allure. Say we're nearing the next Great Depression and you'll get on TV. Mention good times are ahead or markets have room to run. And a common reaction from commentators and spectators alike is that you're either a salesman or economically aloof of risk. And this is a little hard to read, I apologize, but going along with that, we gravitate to predictions and pessimism. Now, you've probably all heard of Robert Kiyosaki, Rich Dad, Poor Dad, wrote a book. When you go to the bookstore, it's blue and purple, the covers. It's actually a good book, but he's probably written 10 more after that. Be careful. But another guy I like to follow wrote a post about him and called it the broken clock because a broken clock is still going to be right twice a day. So this is a chart of the S&P over time. And here's all the different times that Robert Kiyosaki has said, the big one is coming, the crash is here. So 2015, stock market crash. 2018, biggest crash is coming. 2020, Oh, the everything crash. I wanted to make sure I got that. The everything crash was coming in 2020. And then this actually was published in September of last year. And this says, market crash coming October. Well, I'm not sure I saw that in October, but regardless of whether you're wrong or right, a lot of people will wake up the next day and see what somebody that's prognosticating wants to say, because they're always wired to look for pessimism. And there's always a reason to sell. So I highlighted just a few of these. This is another chart of the S&P over time, going back to 09 through recent times. So here's the BP oil spill. Here's the taper tantrum back in 2013. Here's the great stock market sell-off. Remember in 2015, Chinese stocks fell about 45% in 3 months. Here's in about 17, beginning of 18, the Dow fell 1,100 points, biggest point decline ever. And here is the thing we probably all still remember pretty recently. Fastest bear market ever, economy shuts down. Holy moly. If you knew that was going to happen, wouldn't you think this line would just go off the screen? But it happened, it corrected, and here we are today. And this one right here, US Capitol storm, Delta variant, Evergrande, supply shortages, and takes us to today, inflation. And maybe a point to make here is that we should be really thankful for where we live. We live in a really resilient system that succeeds in spite of itself and in spite of, good, bad, or otherwise. We seem to, one of my good friends served in the Army, and he always reminds me of the motto, improvise, adapt, and overcome. So I think our economy and a lot of the businesses in it adhere to that. And if that wasn't enough, we got this thing happening a few thousand miles away. Russia invades Ukraine, so I'm sure everybody's heard of that. A few things to say about that. Just like the previous slide where there's always a reason to sell, gosh, it seems like there's always a war and a reason to sell. So there's World War II, there's Vietnam, there's Gulf War, Iraq War, another Iraq War, and here's Russia, Ukraine. And while the markets, certainly have up and down times along the way, notice that over time, they continue to be productive and move forward. Now, I want to make sure I don't sound crass saying this, but this is something that a lot of people have pointed out and a lot of research went into. You saw a lot of concern leading up to the time where Russia actually invaded. And over time, let's see, we're covering the Vietnam War, the Gulf War, Afghanistan, the Iraq War, and Crimea a few years ago. And what this is trying to point out is this is showing the 6 months before it starts, and then the 18 months after. And what happens is the market usually kind of sells off into the war because the opportunity for uncertainty is just as wide as can be. Believe it or not, when the conflict starts, it tends to start putting some parameters on it. People that are trying to handicap the market and figure out what things are going to do, they have a little bit more of a handle on how to start positioning around that. So the war itself is terrible, but this is something that the market does once the war starts. So this is something I like to point out because, Russia supplies a lot of oil. We've heard about that. You probably paid a little more for gas at the pump. I think I paid $105, which was a personal record a couple of weeks ago. Wasn't real thrilled about that. But I've heard people talk about this thing called oil shocks, and people that were around in the 70s remember these terrible things around 73 and 78 and signs that said no gas today, really long lines. And could we get to that type of scenario today? So this is something called the Chicago Fed National Financial Conditions Index. That's a mouthful, and it pulls together a lot of data. So there's more than one data point in there. But what they pulled together to create this chart tries to get a read on how healthy economic conditions are. And you can see that despite all of the things going on right now, we're nowhere near. See, this is 2020 and COVID. This is the financial crisis. This is getting old, my eyes having a hard time seeing that. That's right around the 1990s there. And then this is back into 78 and 73. So you can see that, at least from this perspective, we don't have anything like the situation we had back then. So that's a good thing. And I want to step back for a second. You know, if you've been around investing for any length of time, you're inevitably going to run across Warren Buffett. If you're looking for something to do, just YouTube, his 1998 talk at the University of Florida. You know, that was long enough ago that he was still in his prime, sharp as a tack. Not that he isn't today, but you'll notice a guy that man is he on. But during that talk, he's responding to some questions about what macroeconomic, kind of big picture, worldwide things to talk about, and goes so far as to say, I don't think about the macro stuff too much. We don't read things about predictions. He kind of gets this look in his eye and goes off a different direction. So what he's pointing out here is it's more important to think about things that are knowable and important. So this little 2x2 matrix is helpful. If you can spend the majority of your time in the area where their things are important and you have a chance to actually know them, get some parameters on them, put your time there, and that's time well spent. Limit your time in the other areas and try to avoid altogether the unimportant and unknowable. You know, I'm sure I'm not telling you anything new, but the challenge in today's world is not the ability to get data. We can get all the data we want. The challenge is to be able to sift through it in a meaningful way so you actually get to something that's useful to you and not drown in that data. I like Mark Twain. He has a flair for the dramatic. Reports of my death are greatly exaggerated. So, you know, beginning of 2020, maybe that applies to the S&P 500. So profit margins, how profitable are companies in the S&P? Are they making money? So what you see is it sure has its dips and it has its ups and downs. It's bumpy along the way. But if this goes all the way back to about 93, 94 through present day, and even a little bit of prediction for the next few years, past this, little room for prediction, you'll see that that's still progressing, bumping along. There's obviously the shock in 2020, but look at where we are again. We've recovered that and then some, and the things I see and read indicate that U.S. companies are doing pretty well. So this red line you see, this is another chart of the S&P. This is the price, and this is what's happened so far in 2022. But you can see all the analysts that cover and report on it and try to put out some expectation for what the earnings are going to be, how strong companies are going to be. You can see that that's still up, and it's actually ticking up even more. So it's improving from where it was quarter over quarter. So this is what's expected to be on the slate, even though prices have moved around quite a bit. And this might explain it just a little bit better. So focus your attention on the portion of the slide on the right-hand side. So it's percent change in earnings and valuations. And I like to think of this thing, there was a famous investor named Michael Price, just passed away recently. He talked about sizzle and steak. He was really good at distilling things down to what was important and what was actually meaningful. And this kind of gray nondescript line right here, well, that's corporate earnings. By golly, look at those. Those are just marching right along and doing very well. That's what you might call the steak. There's meat there. That's meaningful. That's real stuff. Now, this blue line, so this is the choppy line, and this is what's down so far. This is multiple growth. So this is the sizzle, and this is what you might think of as the popularity of the stock. So if you know, rumors are good, it's popular at parties, people are piling into that, that's what helps bid prices up above and beyond in times where, in really good times. But that's not necessarily the meat. And then this green line marries the two. So this is the actual price. So multiple growth or multiple depression, and then earnings growth, put those two together and you get the price of the actual stock. So I'm okay with some of this from time to time, as long as this is doing what it's supposed to, because over time, fundamentals will win. And this chart breaks that down in just a little bit more detail. So this is the S&P in total. and that's that 4 point something, getting close to 5 that it's down so far this year. These are the different sectors that make up the S&P. You can see the only one that's really won this year so far is energy, and that's up pretty big. So if you have been in energy, you've done okay. But pretty much across the board, anywhere else, it's been pretty challenged, especially in these areas like tech, communication services, consumer discretionary. And you might not think of some companies that are in there, but things like Amazon are actually in consumer discretionary. They've been rejiggering some of those categories. So that's why you see something like that, which you might think would just be nondescript household items. But things like Amazon are in there, which is, has been more of a tech company, but that's why you see a -9 on something like that. And then you've probably seen this chart before in our meetings. I like to bring this out pretty often in our reviews. Each one of these verticals, going all the way back to 1980 through present day, each one of these is a year of S&P 500 returns. Each one of these gray bars is where the S&P ended any particular year. So here's 0, there's 20, there's 40. So you can see a lot of healthy end-of-year returns along the way. But the thing I like to point out as well is, see all these red dots down here? For any given year, it didn't go to a certain point and just stay flat the whole year. It fluctuated a lot. And if you look at these, you'll see that a lot of years, there's multiple double-digit movements in those stock prices throughout the year. And if you're just looking at the total move, this year hasn't been so bad. It's just that it's been to the downside thus far. And just one slide, kind of back to the Mark Twain thing. How many people have been getting coffee with a friend and, oh, if I had just invested in Amazon? Well, okay, yeah, I'm cherry picking, I admit it. In the year 2000, Amazon shares fell 80%. How many people would have owned something like that and held that and said, yeah, I feel good with that? You don't really know until you've done it. But that's what the chart looked like back in that day relative to all the time after it. So I'm not saying that we're smart enough to pick the next Amazon necessarily, but what we're trying to do in times like this, we're trying to look for companies that got, the proverbial baby got thrown out with the bathwater, and we're looking for things where over the next 20 years, there's a lot of room and margin for those companies to do well because we want to hold things like that. Consumer finances, I like to show this one a lot of times in review meetings as well. This one shows this chart in the upper right-hand corner. This shows household debt payments as a percent of disposable income. So how much are you paying versus how much you're bringing in? Notice this goes all the way back to 1980. That was actually a lot higher and increased quite a bit, kind of peaked out right around the financial crisis and has been going down since. And here we are today. So generally, households are in pretty good shape relative to history as far as how much money they're bringing in versus how much goes right back out the door. Now, this one right below it, this is flow of personal savings. You can see that there's a blue line that's a trend and basically stuck with that. Here's where the government flooded people with money during COVID, and that went down. There's been a couple spikes with savings and things like that. This spending down of the line, that looks a little concerning. So this one, a company called KKR that we follow, it's a private equity firm, they put this chart together, and I like this because they add a little clarity to how much they think can be spent down. So there's a lot of personal savings that happen. They think that personal savings rate right now is about 6.4% and can fall, 1.4 or so, maybe down to 5% before, because one of the things you're hearing right now is how much can go on before people actually change their spending behavior and their activities and what they're doing. So there's still some, at least according to KKR, there's some room for some more spending down before behavior really has to change a whole lot. And consumer confidence. This is a big one right now. Remember I talked about the sizzle and steak? Consumer confidence is a lot of that sizzle factor and the multiples companies trade at in the market. So what this is a measure of sentiment from consumers and the returns 12 months after that point in time. So you can see we're way down here right now. And there's only been a few times in the past 20 or 30 years, this goes all the way back to 1971. So February 1975, that was pretty low. And the next 12 months, the S&P did 22. Here's a May 1980. The next 12 months, the S&P did 19 something. It didn't get quite as low, but here's 1990. And actually, the next 12 months saw the markets up about 29%. Here's November 2008, and here's August 2011, 22 and 15. So this isn't a guarantee or an absolute prediction, but it helps, predictions about the future are pretty hard because we haven't done it. So we're limited to trying to infer some things from the past. And it isn't necessarily a guarantee, but maybe it can help you get a feel for if things similarly have happened in the past, could something like that happen again? So that would tend to point you in a good direction. Unemployment and wages. You hear about this all the time. So gray is the unemployment rate, and you can see that's fluctuated over time, continued to have dips, but it continued to go generally have these valleys where it was down quite a bit. Here it was at historic lows, COVID hit, and we're getting close to that same historic low. We're almost back to that again. So employment is pretty darn good right now. Wage growth, that's the blue line. And you can see that for a long time, wage growth was fairly stagnant. And then, COVID hit. Where are we right now? We're just talking beforehand about our daughter and other family members, and you guys are seeing it too. For people looking for jobs in a lot of areas right now, they have a little bit of an upper hand over the companies offering them the job. And that's why you're seeing that wage growth. So does that add to this inflation thing a little bit? Yes, it does, but it's probably a benefit to the people that can readily use it the most, which isn't such a bad thing. Okay, so a little bit about interest rates and inflation. So again, I got to lean over a little bit to read this. Ben Carlson is another guy I like to follow, very smart guy. So he was tongue-in-cheek here saying credit card rates are at 15, mortgage rates are now at 5, savings account yields at the bank are 0.1. Feels like the mob will give me better terms than a bank right now. And he may not be far off, because here's the cost of safety. Fed funds rates a little over 3, a little over 0.3. Money market rates are as close to the bottom as you can get practically. The things people used to feel safe in and get something on their money, CDs, 0.2% is not all that great. So inflation, the 25-year average was about 2.3, although we had spikes around that number. But for 25 years or so, that was about the average. And here we are, February 2022, about 7.9. That's pretty darn high. So some comments and questions. Will inflation slow economic activity and push us towards a recession? That's kind of a big $1 million question right now. The Fed, from late in the year last year till recently, especially just the past few days with Brainerd putting some tough talk out there and causing some market fluctuations, the Fed has quickly went from being dovish or being expansionary to hawkish or wanting to tighten. They've really changed their tone quite a bit. And I think part of that is the hope that tough talk will help the markets adjust without maybe doing some of the actual raises, so we'll see. The Fed has indicated for around 7 rate hikes of 0.25% this year, and they've already done the first one of those quarter point raises in March. The war in Ukraine and Russia, I don't necessarily spend a big part of my day studying all the products from Russia and Ukraine, so a few of these were a little surprising to me. You may be surprised as to some of the things that come from these two countries. Sunflower oil, something like 77% comes from there. The rare gas neon, about 50% comes from there. And an important thing to note there is that gas is used in semiconductor manufacturing. So that's a real problem today because semiconductors have their own worries and problems. Now with this war, they got that on top of it. You're probably all aware of wheat, potash, and fertilizers, so a couple more things contributing to some of the commodity and inflation this year. And I would be remiss to not at least mention mortgage rates. The past year and a half or so has really been a blessing if you were able to buy a house or refinance your current mortgage. And people are up in arms about recently that going up to about 4.4. But I have to ask, for people that have been around a while, who would have killed for a 4.4% mortgage back in the early 1980s when it was pushing 20%? You would have thought you were in heaven. So as far as mortgage rates and housing, demand still outweighs supply. Refis obviously dropped very sharply in February. It's more difficult for new buyers because if you're a new entrant in the market, you weren't able to sell an inflated house to change houses. You have to start from scratch in an inflated market. That's tough. So will this cause prices to level off or even drop? Maybe. And do we think that maybe some of these different things can help balance each other out and get a little bit more normal market? Maybe remains to be seen. So when you talk about interest rates and inflation, probably the thing you hear the most, it's a fan favorite, you hear this thing called the yield curve. And it can be a very confusing thing, but maybe we can try and break that down a little bit. So it has to do with bond prices and the rates those bonds pay. On the left-hand side, you see how bond prices are being pushed down and interest rates, the rates they're paying then, go up. It's an inverse relationship. So the way to think about this is when bonds are selling, lots of people want to sell bonds, there's pressure and the price lowers. Well, what that means is the yield goes up because those bonds pay a certain amount, but then when you divide that payment by a lower price, it's a higher yield, a higher number. So that's why shorter term bonds have jumped up recently. And vice versa, on the other side, buying demand increases bond prices. So when you have a certain payment or yield divided by a higher price, that yield actually goes down, and that's why you see lower prices on the curve. So what does that look like in real life? Well, bonds, believe it or not, had their worst quarter this past quarter in over 40 years. Very, very challenged because interest rates are going up. So existing bonds are less attractive. The Bloomberg U.S. Aggregate Bond Index was down 6%, its biggest quarterly loss since 1980. 10-year Treasury bonds jumped up to 2.35 in Q1, which is huge considering they ended the year at 1.5. In the bond world, that's a big thing. So these curves, this is that yield curve that people are always talking about. What they want is kind of a frown face shaped yield curve, which is more like the gray one. What we've got recently is sort of a smiley face, and this is what you call an inverted yield curve. And this is what makes the headlines go crazy because, again, people think that in the near term, bonds are not going to be a very good place to be, so they're selling them, and the price goes down, the yield goes up on all these, so they rise. And then what they're really doing is they're buying longer term bonds, so the prices go up and the yields go down out here, and it creates this frown face, which is not what you want to have so much of. And the thing you'll hear all the time is the 2-year and 10-year. So that's the thing to think about when you're reading the headlines. Just quickly, this shows the 10-year and 5-year yield, the 10-year and 2-year, and the 10-year and 3 months. So these fluctuate over time, and you can see how the two of them are very close to inverting and have. The one that's an oddball is that 10-year and the 3 months. So that's where, and I'll skip past this for the sake of time, but Jerome Powell, if you're interested, he tends to key in on that 18-month time frame, and you can see that the idea there is that's nowhere near inverting. So you get conflicting information on that. This is another thing that is great to think about. This is called credit spreads, and it's the difference between treasury bonds backed by the government and corporate bonds backed by businesses with the same maturities. In good times, you're going to see this spread be narrow and low. So that means there's good health in the markets. When it's wide, there's bad health in the markets. There's 08, 11, 16, 20. So where we are right now would signal pretty good health. And then recession. So recession indicators are useful tools, but poor masters. Always remember that. This is one of JP Morgan's tools that, it can be one of a bunch of things you look at, but don't rely on that totally. The one thing that's bad is consumer sentiment that we talked about earlier, but a lot of things are still very positive, and according to them, economic chances of a recession in the next year are pretty low, only about 8%. So that's not terrible. So investors in a volatile market. Investors can get high returns over the long run because occasionally they experienced and lived through downturns in the short term. Right now, we're here for you. Questions to ask us and be thinking about include reviewing my financial plan and goals. Can we revisit my risk tolerance? Do my investments create an overall diversified plan? And has volatility in recent times created any good opportunities? And investing is like driving. I'll leave you with this. Incremental adjustments are better than sharp right-hand turns. So there we go. Thanks for your time, guys. Turn this over to Joe, and then we'll have a little bit of Q&A after Joe.
Jill, you want to get the, oh, she's getting the door. I'm going to raise the lights actually a little bit here. There we go. And can we flick I think we can flick this off. Can I just turn it off, Dustin?
Yeah.
The projector? Press power key again. There we go. All right, I'm going to do it a little bit old school. Bring you guys back to the class. I'm going to be using the whiteboard. Hopefully everyone can see, and hopefully my writing is legible. All right, everybody. As Dustin said, I'm Joe Vanderhulst. I'm an attorney. Work with them here in Plainfield. And what I wanted to do was just give kind of an overview of different estate planning tools that you can and should be using. As Dustin said with his reference to Warren Buffett, I didn't know he was going to say that, but I thought it was really good about the things that are important and the things that are knowable. Do I need to move? So I'm in you're just adjusting for me. Okay, awesome. What estate planning does is it turns things that are unknowable and makes it so that you're prepared so that they are knowable, because they're very important. The fun thing about talking about estate planning is, we're thinking about death, and that's always fun to think about. In the last, it makes it interesting, makes it fun. But the thing is, it's unavoidable, it's knowable. The best thing we can do is be as prepared as we can be, and it's not all about death. As Jill was saying, there are things that we need to have in place and that we should have in place for lots of different circumstances, whether it's a general power of attorney or a healthcare power of attorney, and I'm going to get to all those things. So as Dustin was talking about, planning and building your wealth. What estate planning does is you're thinking about, well, what's going to happen when you're gone? And the thing to keep in mind, and the thing to me that's important, and I see it when I'm going through an estate in a probate process, is estate planning is not for yourself. It's for the people afterwards. And I guess I can't stress enough, and it obviously sounds self-serving, how much those people will appreciate if everything is lined up, if everything is taken care of, if all the T's are crossed and all the I's are dotted. And for those of you who have all those things all taken care of already, that's fantastic. But there are things that you might not be thinking about, and it's really for your loved ones afterwards. Because a lot of times, especially when people are younger, they think, well, estate planning isn't for me. This isn't the kind of thing that I need to be worried about. These aren't the kind of things that I need to take care of. But everybody has a bank account. Everybody has bank accounts. Everybody has vehicles. Everybody has, a lot of people have children, and these are all things that if we don't get them squared away now, or at least have a plan now, well, then who knows what's going to happen? Or what is going to happen is not going to be what you want. It's going to be what the rules say. And we attorneys like rules, but they are often not fun when they actually have to be applied to you and to your family. So kind of the way I wanted to approach this was, give you an idea of, obviously, this is going to be short and it's going to have to be kind of, 30,000 foot view because I'm between you guys and the food. Obviously, feel free to get up and get some food and snack while you're sitting. But give you an idea of what is the toolbox, kind of what's the universe of the tools and the mechanisms that you can and should be using as far as your estate planning goes. So number one is the default. And hopefully, intestate, that's the default. And that's just the law. That's just what Indiana law is going to do with everything you have, whether it's property, children, whatever. That's what the law is going to do if you don't do anything. And it's not the end of the world. A lot of people think, you hear stories about, oh, so-and-so died without a will. Oh, what's going to happen to whatever, their kids or their money or anything. But I mean, there are rules and it'll go to a court, and basically a court is going to decide, according to certain rules, where things are going to go. And in general, it's going to go the way you would expect it to. Kids go to next of kin, whoever the court decides is, best suited, and things will usually go to next of kin. But again, it's a long, drawn-out process. You have to go to courts. Attorneys have to be involved, very unfortunately. And it's something that's basically what you're wanting to avoid when you're coming up with a plan. You're wanting to avoid the default, which can be, at the end of the day, it's not what you want. The second thing, and this is the thing that most people think of, is a will. Usually will and testament, but it's really thinking of a will. This is probably the most common, and it's the most economical way to plan your estate. And it's just a legal document. Most people know what it is. It's a legal document that's just setting out, here's what I want to happen. Here's who I want to take care of my children. Here's who I want to have custody of my children in the event that you have minors. And here is where I want my different assets to go. It's simple, it's straightforward, but the problem, and it's not really a problem, but the issue that it has is it needs to go through probate. And probate means you have to go to a court to get the will taken care of, to get it processed, to actually affect the things that you said you wanted to happen. And again, probate's not the end of the world. Courts and lawyers aren't that bad. And if you can avoid probate altogether if it's less than $50,000, which sounds like not very much, but there's ways that you can get your estate below $50,000. And I'll talk about what the other ways the other tools that you can use to accomplish that. So again, I had mentioned that it's more economical, and the other main tool is trusts. So most estates and most estate plans are either will-based or trust-based. And the main difference between those two things is a will is going to need to go through a court and go through probate, and a trust does not, which I was discussing with someone before we started, where, yeah, there was someone had run into some confusion about that. So you can see the advantages of that, the advantages of a trust, is that your family doesn't have to go to court. Your family doesn't have to, go through that process. Everything will just happen through the documents and through the things that you established with the trust. But one of the other differences is, and this is where we attorneys can kind of, I don't want to say get in trouble, that's the wrong word, but it is a little bit of a pay now or pay later. Because a lot of times people will look, especially if they look on LegalZoom, which obviously LegalZoom is great, and you can use LegalZoom if you want, it's perfectly fine. But you'll look on there and you'll see, the price schedules. And it's, a will is only, a will is 3 figures. And then a trust is more expensive. But keep in mind that with a will, when it comes time for your family to need to actually process it and probate it, they're going to need to pay for that on that end. And then paying for that is going to come out of your estate on the back end when they're probating the will. Whereas a trust, because it doesn't need to go through probate and it just becomes effective and the terms just get processed just when you die, you don't have to go to a court and you don't have to pay attorneys on the back end. So kind of some details about what a trust is for those of you who don't know. So a trust is an actual separate legal person or entity from yourself. So think of it like a corporation or an LLC. So if you have a small business, and you could run your small business as a sole proprietorship where all your liabilities and everything is just going through yourself, but then you're on the hook for everything and everything is yours. Or you can create an LLC to push the liability to something separate, to a separate legal entity that you own, especially like with for example, a single member LLC. You can own the LLC altogether. It's all yours. Everything about it is yours, but it's separate from yourself. And that's what a trust is you're setting up a separate legal entity that you are moving assets into now, as opposed to later when you die. So you're actually moving the ownership of whatever it is, your real property. You can do it with vehicles. You can do it with accounts, with all the property that you have. I think it was the ice maker, actually. It sounded like a knock at the door. Yeah. You're actually moving things over now as opposed to later. So that the property changing hands with a will, the property changes hands at probate when a court approves it. With a trust, you're actually giving things now. You still control it. Obviously, everything is still within your control because you would be the trustee and the grantor, but you're kind of, as I was saying before, you're doing the legal process, you're doing the legal work now as opposed to later. Oftentimes you'll hear these referred to as living trusts or revocable trusts. But not every trust is living and not every trust is revocable. That just means that you have control of everything that's in it. And that, at any time you can take something out, at any time you can put something in, however you want. One thing that sometimes comes up, and this is kind of a little bit beyond the scope of what I wanted to cover, an irrevocable trust. Irrevocable. I butchered that one. An irrevocable trust is something that you put money in, or you're putting assets in that you then actually don't have control over anymore. And that can actually, the context where you might want to use one of those is nursing homes, protecting your assets from nursing homes. Because sometimes nursing homes will try to, collect money, but if it's an irrevocable trust, then it's not yours anymore. You have set it up so that the terms of it were under your control, and what happens with the assets in it are under your control. But you've given up control of those assets, and you can't get them back. So that means that the nursing home can't get it either. It's a little bit, getting a little bit far into the weeds on that one.
So is it a good thing?
Well, it depends on what you want to do. See, it's a good thing in the sense of if you know or have reason to believe that you have a bunch of your assets that you just want to be passed on, and you're confident that you have enough to take care of nursing home expenses and whatever that you need for yourself, and you just want your inheritance basically to be separated, then you would go the route of an irrevocable trust.
But then,
Does that make sense?
then
That
you would no longer
it's
have
gone.
control over that. You couldn't get it.
Exactly.
Okay.
So it's gone, but so the advantages, nursing home can't get added.
True.
The disadvantages, it's gone. Unless, of course, the trustee, I don't want to get too far into the weeds.
No.
The trustee you could have some terms in there where the trustee, if they decide to help you, then they could help you. And that kind of goes to, I'm sure people can have, So the main thing to think of is a trust is again, think of it like a corporation or an LLC, where it's an actual legal structure that you're moving assets over to now, as opposed to a will, which is a legal document that is saying, here's what I want to happen then. Here, Your Honor, Judge, here's what I want you to do and what I want to happen. One note about probate, which is when your personal representative or executor is going to be ironing out the will with the court. There's supervised estates and unsupervised estates. And a supervised estate is one where the court is actively involved, and you have to report, your executor has to report to the court and update them, and the court has to approve every step that they take. And then there's unsupervised estates, which is preferable. You want to make sure that's in there if you have a will, where that means that your executor can basically do what they need to do without having to constantly. They will basically file it with the court at the beginning, take care of everything they need to take care of, and then just file a closing document saying, here, Judge, this is what I did. So that's a note about probate. The last thing I'll say about trusts, and this is a whirlwind tour, but is that it needs to be funded. we ran into something recently where someone had come into my office and they said, well, we have this trust and it got set up, but the attorney, he's retired or whatever. Can you take a look at it? So I looked at the trust and the trust was fine. The issue was they had never put anything in it. So they had this legal document that they paid a lot of money for, and they never retitled their home. So it was in the name of the trust. They didn't retitle any accounts. They didn't retitle. So the trust existed, but it had nothing in it. Nothing was actually in it. So then when it came time to actually take care of things, they ended up having to go into court and having to take care of things that way anyway. The last things that I'm going to go through are the things outside of wills and trusts, which are the two main things, a will-based estate and a trust-based estate. Things that you can use that you may not have thought of, and things that you can take care of now that you may not have thought of. And if you have, that's great. It's wonderful if you're on the ball. Things that you can do that are kind of apart from a will and apart from a trust that are fairly simple and straightforward, and that most of the time you don't really need an attorney or anything to take care of. And those are what are known as will substitutes. One example is having beneficiaries. On your bank accounts, on your investment accounts. This is when an account is payable upon death. And you can do this with, as I say, you can do it with investment accounts, bank accounts. You can even do it with vehicles. A lot of people don't know about that one, where you can make the title of a vehicle basically payable upon death. When I die, this person owns this vehicle. And what that does is it takes all of these things and takes them out of your will and also out of a trust. It kind of takes it out of the estate and just makes it operate by function of the terms of the account. So that can be, as I was saying, as far as getting things under 50,000, you could only have a will and not invest in a trust and kind of take care of your accounts and assets just by naming beneficiaries and doing payable upon death. And you can kind of take care of all your assets without even a will or a trust even kind of being implicated. So it avoids probate, keeps things out of your estate, and operates outside of your will or trust. Another thing is having joint ownership. The most common is with real estate and bank accounts. So, for example, the common example in real estate is when husband and wife, own something together. When one of them dies, the other just owns the property automatically. That just happens by virtue of that they're both on the deed. You can even get fancy with joint ownership, where you can actually deed your house to your kids while you still have a life estate in the house. So you own the house, you live in the house, it's your house, but they already own it from the standpoint of property law. So that when, again, this operates outside of a will, outside of a trust, where just by virtue of property law, it's just going to pass to your kids automatically. Bank accounts are the same way. Make sure you've got if you have multiple people named on the account, it's just going to pass automatically, and you're going to avoid probate, you're going to avoid, everything's just going to happen automatically. The last couple of things I wanted to mention are life insurance. And the main thing I'll say about that is that it's commonly misunderstood that your life insurance is part of your estate, that it goes into your trust, it's part of your will, but it's completely separate. It's just a contract between you and the company. And when it triggers, it's just going to go directly to your beneficiaries. Some people will sometimes ask, is it a good idea to name your trust as the beneficiary of the life insurance? You can do that. That can get a little bit complicated. It's usually better just to have it go to the beneficiaries that you want it to go to, the named beneficiaries directly. But it is an option to make, like I say, with the joint ownership, with will substitutes and life insurance, you can just name your trust as the owner of everything, and that's usually the advantage of a trust. Last thing I'll mention is, and this often gets overlooked, is gifts. If you can, if you just give away assets, then that also avoids probate and also avoids potentially having to use a trust. If you know where you want things to go, and you've taken care of, you have things lined up to take care of yourself, if you just give it away now, that no one can stop you, no one can, you don't have to worry about a court. You can just, and there's a certain amount of, one person I was working with had pretty much taken care of, they'd almost given away everything already. And we were doing her estate planning, and I was like, wow, well, everything's already taken care of. And she had a kind of a personal gratification of that she was able to witness what she was doing. A lot of times when people get inheritance and stuff, it's kind of a big deal for people, but she was able to actually just see that directly, while obviously making sure she had what she needed. The last two things I mentioned, which are the last two things I'll mention, which are kind of part of estate planning, but they're kind of separate from them, are powers of attorney. And I'm just going to use the acronym because it's getting late in the day. A power of attorney is something that you can put in place apart from your estate planning, and that, in my opinion, often gets overlooked and that people should really have in place. As Jill was mentioning, if you have a situation where someone gets hospitalized and the next of kin or the spouse doesn't have a power of attorney, usually the doctors are always going to, the default under the law is that doctors are going to consult with next of kin. But if you, for example, don't have a general or healthcare power of attorney, you can't get medical records. You can't get, there's a lot of things that you just can't get. And so the two main kinds, there's kind of three. There's a general power of attorney. There's a springing power of attorney.
Spring, like it sounds.
Like jumping.
Okay.
Yeah. And then there's healthcare power of attorney. A general power of attorney is something that anyone can put in place, that just becomes effective now, that basically says this other person, and they don't have to be related to you, you can do it with anybody, this other person can do A, B, and C things that I can do. And you can make it as broad or as narrow as you want. And there's a specific statute under Indiana law and under any state law that outlines what are the things that you're allowed to, basically delegate to somebody else. And it exists now. Like, you can make it in effect now. You can make it survive your death. which is a general durable power of attorney. The advantages of that, I always tell the story of my wife has like an old store credit card that she's had since she was, I don't know, in her teens. And I have a general durable power of attorney for each other. And I had to deal with it. I think she had just had a baby or something. And I had to call the credit card company, and they're saying, well, we need to talk to her. I'm just, okay, come on. But if you have a general power of attorney, you can say, no, I can do anything she can do, anything. So no, you don't need to talk to her. She's unavailable. So that's something that a general power of attorney is saying. And you can limit that. Like that'll happen sometimes if you're having somebody buy property for you, or you're having somebody buy a car for you, you can do a power of attorney that's specific to, I'm having this person, they're authorized to do real estate transactions, or they're authorized to buy and sell stock, things like that. A springing power of attorney is just one that doesn't come into effect now, but that comes into effect when something happens. So either you can make it so that if you become incapacitated, it comes into effect. If I become incapacitated, such and such person can take care of whatever. And you can list the specific things you want them to be able to take care of. The caveat with the springing power of attorney, and why I usually recommend a general power of attorney instead, is that there can sometimes be debate over whether it has come into effect or not. So if you say it's when I become disabled, well, who decides that? How do we know you're disabled? Who decides you're disabled? What if someone disagrees that you're disabled and goes into a court to try to contest it? So in general, if you trust someone to give them the power of attorney, just give it to them now. And, obviously tell them not to sell your house now. Or what you can do is you can put it in effect. What I've done for some people, if they're like, yeah, but I don't want them to sell my house right now. Well, usually you wouldn't give it to them if you didn't trust them to do that, but you can put it in effect and then just don't tell them. Or you tell someone that you trust, so that way they know once you become incapacitated, oh, I have the ability to take care of all their accounts and take care of their stuff. These can come in really handy, especially as we get older, but even who knows what's going to happen. You could get in a car wreck, and if no one else has if no one else is named on your bank accounts or on whatever, no one can do anything. Whereas if they have a power of attorney, they can. Last thing is a healthcare power of attorney, which is specific to your healthcare decisions. The default under the law is next of kin. The issue with that is sometimes it's not clear who next of kin are. B, doctors will sometimes say, the way the law is kind of written, doctors will say, well, yeah, I'll consult with them, but ultimately I'm going to do whatever I want. Whereas a healthcare power of attorney says that this specific person, usually you should only name one person, this specific person has the same authority and decision-making that I would have if I were awake and if I were aware. One thing that sometimes people don't think of is that person doesn't need to be a family member. Sometimes you don't really think of that. You just instinctively think it's, a family member is going to have your best interests. But if you know someone that you trust who's not a family member, again, I should have put a disclaimer at the beginning, like Dustin did. Nothing I'm giving you is actual legal advice to you personally. But if there's someone that you know and trust who's not a family member, who you think would really make the right decisions, that might actually be better. Because a lot of times when something happens and it's tragic and something happens to you, your family members are not, like, they're too distraught or whatever to think clearly about what the right thing to do is. Obviously, you got to really trust that person. But yeah, that's something to think about with a healthcare power of attorney. So that's about everything that I had. I'm sure I raised more questions than I answered, but I just kind of wanted to give you an idea of, this is it's not the complete universe, but these are, the tools in the toolbox that you should be thinking about, and that you can and should be using, especially in this area here, where, like, these are just things that you can be doing now, things that you can have in place now that you maybe didn't think of, as far as, oh, I could just name a beneficiary on this account and I don't even need to worry about it. Yeah. So hopefully that's helpful. Hopefully it gives you an idea of, again, the things you should be thinking about and what your options are as far as your estate planning.